Good? So I'm going to have a couple of new categories over here. I'm going to have a assets equals liabilities plus owner's equity plus revenue minus expenses. Okay? And here we go. Let's open for business. Day one, people have seen our ads in the newspaper, heard our ads on TV, and guess what? They show up. We're actually going to have customers. Right? Customers come in the door, we take their little happy pooches and we run them through the treadmills and over the equipment and we train them and we send them home happy and tired. All is well, right? What's the benefit of that? We get to charge people. And what do they give us in exchange? Money, cash. Now, cash is king. I'll say that now, you'll hear it a lot. Right? We're in business, but if we keep paying bills and we don't have any cash come in the door, we're going to run out because we only have $1,000, right? What happens when a business runs out of cash? It's done. Even if you're profitable, you're still done because you can't pay your bills. So cash is king. All right, so we go out and all these customers come in, we train the dogs, we send them home. How much did we charge them for the day? Let's call it a week. They've been here all week. They've been coming all week. How much do we charge them? $200 for a week?
Oh, no, that's okay. So.
Yeah.
That's more like $50 a week.
How many customers do we have?
It depends because I'm not
It's more like
All right, let's charge them $5,000 in total for all the customers for the whole week.
Sure.
Come on. Hold it. I don't want to be accused of fudging the numbers. You make up a number.
Well, I'm just thinking of my own experience with dog training. A 6 weeks course is like $156. So I guess that doesn't.
Okay, but we're across the street from a Starbucks and we take little pictures of the dogs and we got this premium thing going on. So we charge a little bit more. Okay. So what can we, $1,000 a week for all the dogs. Say we have 20 dogs.
No.
20,000.
Yeah, so that's why I said let's charge them $5,000. Fair enough? All right. So we have revenue of $5,000, and they paid us, right? So what do we get in exchange? We provided a service, and we get cash. We're going to come all the way down here, and we're going to add to cash. Now how much cash do we have? 6,000. 5,000 equals 5,000, right? Good? Okay. So the week is over. Now we need to do what with our employees? Pay them. Because otherwise they won't come back next week. Okay? How much do we have to pay our employees this week? $1,000 seems to be the going number here. Okay? So I'm going to record. What do we have to give them? Cash. So my cash goes up or down? Down. So I've got a $1,000 negative. And I'm going to come over here and I'm going to record it as an expense, right? It would be, we could even call it wages expense. And I need a $1,000 wages expense. Good? Okay. Am I in balance?
No.
Why not?
Because you took cash away from there, but then you added over here.
Bing, bing, bing. We have a winner. Okay? Only one of you caught this. I got a positive 1,000 here and a negative 1,000 there. Only one of you caught it? Okay? Did I make a mistake? No. Why not? There we go. Okay. Assets minus 1,000 equals liabilities plus owner's equity plus revenue minus expenses. The fact that the minus sign is here changes the sign of what happens out here. So it's a minus 1,000 equals minus 1,000. So I'm in balance here. Good? I'm glad you caught it. But I want to make sure everybody gets that. Does everyone see that? Okay? It is the most algebra you will see in the entire course. That's it. I'm done. Okay? The sign carries down. That's all I got to teach you. Are we good? Okay. What other kind of bills might we have to pay from this week's expenses? Utility bills. We had lights and things like that, right? So we have to pay PG&E. Let's come over here and give it the name utilities. How much is our utility bill going to be?
100.
How much?
100.
$100. Okay, how do we pay them? Cash. My cash goes down. Minus 100 equals minus 100. Am I in balance there? Good? Everybody's happy? Okay. That is as tough as it gets. That's the full-blown accounting equation. Okay? There's only one more thing I want to show you tonight that's different. There's two things I want to show you. I stand corrected. Remember this guy lent us money to buy that equipment? We owe him money, right? And we got some cash, right? We've got $3,900. Let's say we want to make a payment on this. We're not going to pay all of it. We don't have all of it. But let's make a payment on this. Good? Yeah. How would we record the making of a payment here? Yep, I'm going to give up cash. Let's give him, say, $3,000. So subtract cash. And my liability goes which way, up or down?
Down.
So I'm going to subtract from my liability like that. Minus 3,000 equals minus 3,000. Am I in balance? Yes. Excellent. So we're good here. Okay? So let's say we're at the end of another accounting period and we want to check to see if we're still in balance, right? Have a quick look at our financial situation. Good? So again, I'm going to go and I'm going to total each of our accounts. So what do I have here? 6, 5, 2, 1,900, correct? You got to check me. It's late at night. I do my math wrong late at night. All right. 6,000 prepaid rent remains. 6,000 prepaid rent. Supplies remains 1,000. Prepaid advertising remains 2,000. Equipment still 5,000. Right? Nothing happened there. Liabilities. What do I have in liabilities? 2,000. Marker smells like, oh, it's a scented one. It smells like a green apple. How nice. How much owner's equity do I still have?
10,000.
I still have 10,000. How much revenue do I have? Say it, 5,000. You got it right. And then I have wages expense of 1,000 and utilities of 100. Good? All my totals are good? Okay. I wonder if this blue marker works. Let's find out. Let's add these up. 1,900 plus 6,000. 79 plus 1,000. 89 plus 2,000. 10,9 plus 5,000. 15,9. My assets are 15,9. It only sort of works. Sorry. Okay, my liabilities are 2,000. My owner's equity is 10. So I've got 12,000 here. And the blue marker's got to go bye-bye. $12,000. Now I have revenue and expenses. I have 5,000 minus 1,000 is 4, minus 100 is 3,900. Okay? 15,900 equals 12 plus 39 is how much? 15,900. I'm still in balance. We've done something right. That's a very, very good sign. If you ever come up out of balance, you have to go back and figure out where you went wrong. Okay? On Blackboard, I have a little, there's a tab there and it's a Word document that gives you some suggestions on where to go look for mistakes. Things like making 2 positive entries on one side and not one on the other side, or transposing numbers, things like that. Okay? Just another cool thing that I throw on Blackboard for fun. Oh, hey, the other cool thing about Blackboard is I put a lot of web links out there to articles that tickle my fancy at whatever point in time. You know, what do job prospects look like in the accounting field for the next couple of years? Exciting things that go on with companies. You know, somebody declares a stock dividend or things like that. So if you want to kind of go check out some other things out in the world and not just listen to what I tell you, there's some links there. Okay? So I'm still in balance. With my full-blown accounting equation, I'm still in balance, right? Okay. What's the full-blown accounting equation? Assets equals liabilities plus owner's equity plus revenue minus expenses. There you go. Now, the other thing, what is net income? Revenue minus expenses. What's my net income? 5,000 minus 1,000 minus 100. Have I made money this week? $3,900, right? We're making money, woohoo. Okay? All good things. Questions on any of that?
Do you
Yeah.
ever or do you ever put more under owner's equity, or is that just like where you start off and that's it?
Well, you could put more under owner's equity. For example, when we're going to buy this equipment and we only had $1,000, if they wouldn't lend us the money but we had to put more money in out of our own pocket, we'd increase cash and we'd increase owner's equity. Okay? And when we get to the end of an accounting period and we close it, which is Chapter 6, but you take your profit, your net income, and it increases owner's equity as well. That's why I show it as a subcomponent of owner's equity. In the end, this all gets zeroed out and it becomes part of owner's equity. Okay? But we'll do that later. Don't worry about it now. Yes, ma'am.
So if a company or business were to get like a cash loan, would that go under the owner's equity?
It would be a different type of liability. You would have, say, a note payable, and you'd borrow the money and record it here. Okay? So cash would increase and your note payable would increase, your liability. Good? Yes?
I think that's the same question. If you started, like, you didn't have any cash, but you got it from the bank. So that'd be an asset, but
Also a liability. Now, yes it is, but when you start a company, brand new company, and you go to the bank and you say, I don't want to put any of my own money in, I just want to borrow yours. What are they going to say? No. Okay? You got to have skin in the game. Okay? All right. Let's hit, now that we've got that basic concept down of the accounting equation. Yes. Let's tackle a couple of more slides, and then we'll do the ads for the class, okay? Sound good? On. Let's hope it works this time, right? Did that light come on above your head?
Yeah.
All right. Yeah, just let that keep going. Okay? I'll try and stay more in the middle. Are you guys having at least a little bit of fun?
Yeah.
Could be a lot worse.
Could be a math class.
Could be. Okay, so let's just run through the concept a second time. I'm not going to write it all out on the board, but I've got a few slides over it, okay? We're going to go start a new company, totally separate from what we just did. These guys are going to, this guy can be the landscaper, okay? The owner puts in $10,000 of money. So what goes up? Cash. And what does he get in exchange? Owner's equity. So the screen used to be much bigger. I apologize to you guys in the back. I've got the little graph, the chart here. Cash goes up. Owner's equity goes up. Am I in balance?
Yes.
Yes. Assets equals liabilities plus owner's equity. Step 2, we went out and we bought some equipment. We go buy a lawnmower, right? You pay $1,000 for a lawnmower. Your equipment goes up. Cash goes down. Am I in balance? Yes. Let's buy some equipment. Let's buy something else. But we're going to pay for it on credit. So we buy, I don't know, what would be $1,500 for a landscaper? A weed whacker? That's an expensive weed whacker.
The best time.
So we get an asset of $1,500. And what do we give up? A liability, account payable. We're going to pay him in a short period of time, 30 days probably. Okay? My asset equals my liability. Am I in balance? Yes. All right. We're going to go buy some supplies. Supplies go up. Cash goes down. I'm in balance. Yes. We're going to pay for that accounts payable. We got to pay for the weed whacker, right? Cash goes down. The account payable goes down. Still in balance. If I list them all out like we had it up on the board and total it all up, and you do the math, I'm in balance. Okay? See, I used to just show these slides and somebody accused me of making up numbers that made it work. That's why we use your numbers and do it live on the board now. Yes, ma'am?
I have a question. So, is owner's equity and cash always going to be the same amount?
On that initial investment, yes. Okay? There are times, and you won't see it in this class, but if an owner brings in, let's say I'm going to bring in $10,000 in cash plus my used truck plus my lawnmower, then you're going to value those as equipment, and the cash will be different than owner's equity, but the cash plus the equipment will equal owner's equity. Okay? So they could be different conceivably, but for this class, they'll be the same. Other questions? All right. Income statement. Revenue minus expenses. Remember, revenue is cash coming or money coming into the business for services that you perform, and expenses are the costs that you pay for things that you use up in the business. And you use it up to generate the sale, the revenue. Good? Okay. Yeah, costs necessary to generate revenue. Revenue and expenses are, again, a subset of owner's equity. Let's see. A few more examples. What did we do here? We provided a service, we mowed somebody's lawn, and we charged them $2,000. I mean, heck, if I'm going to be in business, I got to make it worth my while, right? I pick good numbers. So revenue equals cash, assets equals liabilities plus owner's equity plus revenue minus expenses. Okay? It's in balance. I hired somebody, and I have to pay him his wages. My wages expense is $500. Cash goes up or down? Down. Negative here, positive there. Remember, distributive property, that minus sign slides down in front of the expense, so it's minus 500, so that you remain in balance. Okay? That is the thing that trips up most people in the first 3 weeks of this class. If you get it now, you're way ahead of the game. Good? Okay. All right. Here we go. We're going to mow somebody's lawn and we're going to charge them $2,300. But they're not going to pay us right now. They're going to pay us later. So we get an accounts receivable. Now, accounts payable means we owe money to someone else. Accounts receivable means someone else is going to pay us. Don't get them confused. Receivables good, payables bad, right? Receivable asset, payable liability. Okay? If they pay. Yeah, that's a different class, but what's the one thing you know about accounts receivable?
You get that.
Somebody's not going to pay you, yeah. Somewhere, somehow, somebody's not going to pay you. All right, here we go. We're paying our utility bill, our expenses increase, our cash goes down. Okay? Here's the one I didn't show you. And to cover your question about owner's capital, owner's equity. In this business, the company made some money and the owner needs to, pay his personal expenses. The owner doesn't get paid like an employee, right? Because he's the owner. But all the money of the company and all the assets are technically his. So at the end of the month, he's going to take $1,000 to pay his rent and, pay his personal expenses. So owner's equity goes which way when he takes money out? Down. Cash goes which way when he takes money out? Down. That's the only transaction I didn't show you earlier. Somehow I neglected that. I apologize. Put them all up there together, total them out, and prove that your accounting equation remains in balance, which it is, and you're good. Yes?
So owner's equity plus revenue minus expenses is owner's equity, but what is
Correct.
the owner's equity part of, is that just investments and withdrawals?
Correct.
So that remains blank except for investments and withdrawals?
Right.
Okay.
And you'll see this in chapter 5 and 6. Later on, we'll take these and we'll close them out and we'll move them over here. And that's the other activity you'll see here, but it's just one entry once a month. Okay?
Actually, in the exercise of chapter 2, you have to do that as well. I did it correctly.
We don't do a closing until at least chapter 5.
Statement of owner's equity, though, and it's not.
Oh, that's just a statement. You're showing how it would all flow, but you're not actually doing it at that point. So yeah, I can see how you would say that. I'm going to say, yeah, okay, you're right. It's not worth arguing over. But I didn't touch on statements tonight. We'll do that later because I think it's more appropriate to tackle it, chapter 3 before we talk about statements. Okay? Yeah. All right. Let's talk about the concept, though, of the statements. And we'll tackle it a little bit. Every company, the owner wants to know some basic things. I kind of covered it before. Am I making money? Where do I find out if he's making money? Income statement. How much cash do I have? That's on a different statement called the balance sheet. So there are 3 basic financial statements to any company. And you always prepare them in a certain order. And you'll see why in a second. The income statement tells you if you're making money. Revenue minus expenses. Okay? It's always prepared first because you need the net income that you calculate there to go to your statement of owner's equity to calculate the ending owner's equity. As if you were taking these amounts and moving them over. Okay? So you calculate the statement of owner's equity second. Tells the owner how much equity he still has in the company. And you need the owner's equity ending amount to go on what's called a balance sheet. And the balance sheet proves that your basic accounting equation is still accurate. Assets equals liabilities plus owner's equity. Okay? So it's to prove that you are still in balance. Good? Okay. all of your financial statements, all three of them, always have a what I call a header on them. And the header tells you what the statement is, who the company is, and the time frame that is covered by the statement. So I always call it who, what, and when. It's easier to remember. All of your statements have headers that are who, what, and when.
What was the what again?
Well, who's the company? In this one, it's Dave's Consulting Service. The what is, this is the income statement, as opposed to the balance sheet or statement of owner's equity. And the when is what time period it covers. So look at what I've got here. For the 1 month ended August 31, 2010, it tells you it covers a period from the beginning of August to the end of August. Okay? So think about it. It's an income statement. How much money did I make between day 1 and day 31 in August of 2010? And very simply, revenue. What did we sell? Right? Expenses. I only had wages and utilities. Total expenses. Net income. $3,600. We made a profit. Notice the format. Revenue's out here. And I have a number. Expenses out here, and then I show the detail. I step in and I show the detail. So if you had an income statement that had 20 of these things, you would list all 20 and you would come up with a total. And notice I kicked the total out into this other column. This is all about presentation. How do you make it easy for the reader to look at and understand quickly? Okay? So I'm not hung up on the exact format. The book kind of is. I'm more into how do I make it easily readable for the user. Who's my user and what am I trying to convey? So revenue, I kick it all the way out here. If I had, some companies will have multiple kinds of revenue. Think about accountants. I have bookkeeping revenue, I have tax return revenue, I have audit revenue, and they may say revenue and then list 3 things. So you would show them indented here, and then show the total out, right? Show a subtotal. But since we only have one, you just do this. Expenses, I have more than one, so I show the header, the detail, the total, and then I just subtract this from this. You do the math down one column, so it's easy to read, and you get net income. Good? Okay. Yes, sir.
Quick question. I know it's a formatting thing, but if you have negative values, do you show them as negative, or do you just understand from the context?
No, I put them in brackets. You have 2 choices. Okay? If you just say wages and it's negative, A, that's going to look funny. But you would put it in brackets. Okay? If you have revenue of $4,300 and expenses of $5,300, instead of saying, you could say net income brackets 1,000, or you could say net loss 1,000, no brackets.
So either's good.
Either's good. Notice one you have to be a little more heads up than the other as the reader. Okay? Because otherwise you just go, oh look, I'm making $1,000. No, read the header. Okay?
What's your preference? Is there an increased preference?
Technically you should say net loss and just show $1,000. Okay? If I'm doing it as a management accountant for internal use, I'm going to show it with a negative sign and I'm going to make it red and everything. All right? Because it's not going out to the general public. I don't have to be that, I don't have to follow convention that exactly. Okay? Yes, ma'am.
Could you say net income
Slash loss and put it in brackets?
and then that way it covers
That is another common way to do it, yeah. Okay, any other questions? All right. So that's the first financial statement. What's the second one? Statement of owner's equity is second. Okay? The statement of owner's equity shows the beginning balance of the owner's investment in the company. It shows any additions that he makes any more money that he puts in, any money that he takes out, and then it adds or subtracts net income or net loss. Okay, if the business loses money, does the owner's investment in the company go up or down? If we lose money, some of the owner's money is going away, right? So it goes down. If the business makes money, the owner's investment goes up. Okay? The statement heading is who, what, and when. It's always prepared second. Dave's consulting service, statement of owner's equity for the 1 month ended August 31, 2010. Again, it covers a period of time. How much was his investment on August 1? How much is his investment on August 31? Here's Dave's capital at July 31, the end of the prior month. This was a brand new company, so how much was his investment then? 0. He put in money to start the company, $10,000. He had net income of $3,600. Remember we saw that on the last slide, $3,600 net income. This number here comes over and goes in here as net income. He took money out. You guys remember I showed you that on the slide. So he ends up with capital at the end of August of $12,600. Everybody follow that? Clear as mud? Yes, ma'am? No, that was a hand up. That wasn't a hair. That was a hand up. Okay. Good? Okay, what's the third financial statement? Balance sheet. Balance sheet shows the assets and liabilities of the company and the remaining owner's equity. It proves that your basic accounting equation is still in balance. That number off of the statement of owner's equity, that 12.6 that we just calculated, you're going to need it to plug into the balance sheet to make it work. Okay? The statement heading is a who, what, and when. Dave's consulting service is the who. Balance sheet is the what. The when is August 31, 2010. Does everyone see the very subtle but huge difference? The when is a single point in time. Now let's think about that for a second. On an income statement, you have revenue for an entire month, right? Here's all the revenue I earned during the entire month of August. In September, if the owner walks into your office and says, hey, how much cash did we have in August? How do you answer that question? What?
Balance date of the month.
Well, maybe that's not what he meant. Maybe he meant on the 17th. Is your cash, is your cash amount the same all the way through? It is not. It changes every day. So you have to define the point in time at which you're telling him, here's what the balance was. So that's what we're doing with the balance sheet. We're defining the point in time. Okay? You're dead right. So, balance sheet, very simple. It follows the basic accounting equation. Assets, liabilities, owner's equity. This is a side-by-side presentation. Sometimes they do top and bottom where it just runs all the way down. Don't worry about that today. Assets, you list them out. Cash, accounts receivable, equipment, supplies. Total them up. Total assets, 12.6. Liabilities. Oh, look, this guy doesn't owe anybody any money. That must be nice. So that's 0. Owner's equity. Dave's capital at the end of the month, August 31. 12.6. Where did we get that from? Statement of owner's equity that we had just calculated. Plug it in there, and you get 12.6. 12.6 equals 12.6, right? So we prove that we're in balance. Now, just as a quick one, if we had started with, this was the amount in the general ledger account, in the account for owner's equity, right? It was $10,000. If I had just gone there and pulled the $10,000 and plugged it into my balance sheet, would I be in balance? No. That's why you've got to get the ending balance from the statement of owner's equity. Okay? That's why it matters. So we proved that we're in balance. We've proven how much money we made. We've in the income statement, and we've calculated the ending owner's equity in the statement of owner's equity. That's all three of the basic financial statements. Good? Questions? Answers? Say the secret word and win $100.
Done.
No one's ever known what to say to that before. That's cool. Who else said something?
I said done.
You did. That's good. No one else ever catches what that one's from. All right. Simple questions. These are the common questions the owner's going to ask you. How do you know if the company's making a profit? Where do you look? Income statement. Excellent. How do I know how much cash the company has? Where do I look? Balance sheet. How do I know what the company owes to others? Balance sheet. Liabilities, right? How much is the owner's investment? What? Statement of owner's equity or the balance sheet. It's in two places, right? Both count. All right. Here's a fun one to think about. If you were buying a business, what would you look for? Okay. What?
I was going to say the NOI, but...
Okay.
Positive cash flow.
Positive cash flow, profitability, right? What? And how much they owe to others. What else? What assets they have, yeah. There's a whole ton of things, but all the information is in these three statements that we've been looking at. Good? Questions? Anyone? Go ahead and turn that off. Or I will. What? No, it's not.